All right. Thanks, Jennifer and Ariel, for getting us set up and for everybody joining today for the Income Calculation 201 training. The agenda for today, we're going to be going over, touching on some regulations and requirements, touching again on the definition of annual income, requirements for verification of income, some more complicated types of income that you may see in your project or program, go over a couple of examples, and of course provide you some resources for additional reading at your leisure. So we did have an income calculation 101 training just about a year ago in September 2021. If you wish to go back and review that video, it is recorded on the website that Ariel showed earlier. It's titled Part 5, Income Calculation. And that was more of the basics of income calculation, of what you maybe see on a more day-to-day basis. So definitely worth a refresher, or if you have new staff to the industry, might be a good place for them to start. And some of the regulations and requirements that guide what we're talking about today for the various types of gap funding that may come from the state. For home, HTF, and this is real alphabet soup, but CDBG, CDBG-DR, or NSP. And when we talk about Part 5, that's HUD Part 5, Subpart F, and that goes goes over all of the income inclusions and exclusions, and of course, the beneficiary and rent use covenant, which is recorded against the land. If you are on the call and you receive state funding, we ask that you refer to your covenant, and we also use Part 5 or home as our safe harbor for much of these calculations. And this is a repeat slide from the 101 training from last year, but merits mentioning again, just because it is guiding how we're thinking about all of the income that we're looking at when we're qualifying a household or doing a recertification. So annual income is all amounts, monetary or not, which go to or on behalf of the family's head or spouse or any other family member. Annual income is anticipated to be received from a source outside the family in the next 12 months. And any amounts of income derived from assets to which the member of the household has access to. So just kind of keeping those in your mind as you're going over some of these, more complicated or more unique sources of income. And just a note, we'll be covering more complicated assets, doing kind of an Assets 201 webinar in the future months, probably in early 2023. But if you do have a specific asset question, you're welcome to drop it in the chat, and either I or one of the other DOHers on the line will be able to assist you or coordinate to answer your question offline. All right, this is also another repeat from the 101, but does merit mentioning. This is something that DOH always monitors when we're looking at files. So verification of income at initial qualification or initial certification, move-in, commitment of home funds or DOH-assisted funds, all items reported on the application must be verified with source documents for all DOH-assisted units. That income verification is valid for 120 days from the date of receipt. The one caveat for home is that home is valid for 6 months, so that's kind of your unique program with verifications of income. And there are some additional nuances for home buyer programs, and that depends on whether it's a project that's to be constructed or if it's existing housing inventory. So if you are running a home ownership or home buyer program or for sale housing, to definitely speak to your asset manager to ensure that you are properly collecting documentation at the right time to qualify the households to benefit from that assistance. And of course, all verifications must be complete by the effective date. So if you have a move-in that's scheduled on September 14th, maybe this afternoon, you want to make sure that all those certifications are already completed and dated on or before today. And you'll want to make sure that you're considering the gross income when determining eligibility, with the exception of business income and self-employment, which we'll dive into today. All right. So covered in Income Calculation 101, we talked a year ago about payments in lieu of earnings like disability, workers' comp, Social Security, SSI, pensions. We spoke then about employment, child support, and unemployment. I believe we also touched on gift income. And today we'll be talking about self-employment or business income, our gig income or our gig workers, talk about income from rental properties, income from annuities, trusts, income from investment accounts, and required minimum distributions. So that's the agenda of what we'll be touching on today. Of course, this is a lot to cover, so we're just giving kind of a 10,000-foot overview of a lot of these. And, if folks on the call have a complicated source of income that's not on this list, feel free to drop that in the chat, and maybe we'll host, an Income Calculation 301 if there's a lot of questions on sources of income that we may not have captured today or last year. So we will start with self-employment. And for all of these different sources of income, we have the same 5 categories that we'll touch on. We're always going to touch on who or what is this, how you're to document this income, how to calculate this income, what might be tricky about it, or what curveballs can you expect, and of course, what is DOH looking for when we come to monitor the project. So I would say if you are new to more complicated sources of income, or maybe new to the field altogether, step 1 for all of these, and I guess certifications in general, is don't panic. Don't rush. There's resources available within your organization, from a compliance manual. There are other resources online. And of course, there's help here from DOH if you really are stuck. We're happy to talk about all of these. This is what we do. So, we're going to be the ones that are monitoring your project. We're here to help you succeed. So, step 1, don't panic. Step 2, find help. So self-employment, we're starting with this because this is one that we consistently see folks panic with. And I think that's because it feels overwhelming. So it's helpful to kind of break it down a little bit. But the first step is understanding self-employment. So this is a pretty broad category. It applies to anybody that has their own business. It may be working as a contractor or a consultant. It applies to those that may not be receiving a W-2 and either receive a 1099 NEC, formerly known as a 1099 miscellaneous, or those that calculate their own earnings if no formal tax form is issued. So thinking folks that, may babysit for their neighbor. The neighbor is certainly not going to be issuing them a 1099, and the person is going to be responsible for tracking their own earnings. Self-employment is also gig economy. I think there's enough questions on gig economy that we devoted a whole slide to it. So with self-employment, it's important to take your time and really ensure that you're collecting sufficient documentation. So for folks that are self-employed, meaning anybody that was in that kind of first bullet above, you want to make sure you're collecting the prior year's tax returns, including any schedules like a Schedule C, a year-to-date profit and loss statement, as well as a business plan summary. So that's pretty basic, just goes over kind of when did this type of work start, who do they work for, what's the frequency of pay, and how much are they receiving in general for that type of work. Folks that are self-employed, they may have additional documentation like contracts or agreements. So if they're a consultant for an organization working 3 hours a week, they may have a contract that can help substantiate some of that, and they may not. So folks that are self-employed, owners are expected to make a reasonable judgment as to the most reliable approach to estimating what the household will receive during the year. So this is one area that's going to require a lot of staff to put a memo to file or clarification in the file of how, what that rationale was, how did they arrive there, and what did they use to make that determination. And owners must include the net income from the operation of a business or profession from that self-employment. So the net income is going to be the total amount, the gross amount that they received from that operation, and subtract out any business expenses, interest on loan, or depreciated computed on a straight line basis. So that's kind of a mouthful. One of the examples that we'll work through in a few slides will be about self-employment. So you can actually kind of see us walk through what we would expect to see in the evaluation of somebody that's self-employed. And what's tricky about self-employment, well, other than it feeling overwhelming, if it might be your first self-employed person that you've worked with, is that if the net income from that business is a negative, it must always be counted as a zero. So if somebody is working at McDonald's and they earn $10,000 a year, and they also sell Avon products, and their Avon business was a loss that year, so they only made $600 and they had $800 in expenses, so they actually had a loss on their business of $200. You would not apply that negative to their wages to further reduce the household's annual income. It would just be that business, income from it was zero. So helping your staff and yourself make sure that you're always working the frame of mind of how much was the business income, and if it's a negative, the income from that is zero. So that's another tricky one that we see sometimes, is if somebody's business didn't do very well and they had a lot of expenses, or maybe it's their first year, to count that as a zero. And also kind of tricky is looking for trends in anticipated earnings less expenses. So if you're looking at a household in 1 year, they make 30,000, the next year 32, then 34, then 36, you can kind of see that upward trajectory, and that can help you in determining what may be the most accurate way to calculate their income. And things that DOH is looking for when we're coming up to monitor a file of somebody that might be self-employed or have self-employment income is, have all of the documents been collected and compared? So are you collecting the tax returns, that business plan statement, as well as the profit and loss statement, and really looking at them in a comprehensive manner? So not just taking the first one they happen to submit and using that for the file, really making a comprehensive evaluation on that. If somebody has not yet filed taxes, so this will apply, pretty early in the year, say it's, maybe March, and they maybe requested an extension, or they just haven't gotten to submit them yet, but they anticipate to submit them by the April deadline. We suggest that you collect the prior year's tax returns from that, as well as the annual profit and loss statement for the year that they have not yet filed tax returns for. And we did provide in the handouts that were emailed out by Ariel this morning a sample of the self-employment certification form, which it's a CHAFA document, but it does remind folks what supporting documentation to collect. So that is also a helpful tool. All right, moving on to gig income. And so what is gig income? This is kind of another version of self-employment. When we talk about gig workers or the gig economy, that's those who are getting work through an app. So Rover, Uber, DoorDash, things like that, but also tutors, babysitters, or nannies that may be kind of getting this type of gig. Also freelancers, so actors, musicians, entertainers. So still thinking about folks in this line of work as self-employed folks. So still, step one, don't panic. Step two, just make sure you're documenting this income. So following the same procedure as self-employment. Some folks in this gig income universe also may have some third-party documentation to back up their profit and loss statement, or to help them kind of walk through it. So drivers for Uber, there's a platform that they can log into and get, a summary of all of their trips that they've done so far, if they're trying to put together that profit and loss statement. And so there's, through that app, there might be some additional tools that will help them, and therefore you be able to get a good estimate of what their income is anticipated to be. And so you're going to calculate it the same way as self-employment, looking at what they've earned historically in the prior year's tax returns, what they've earned year to date through that profit and loss statement, and looking at how to best project their income going forward. And what's tricky about gig income is COVID had some major implications for freelancers and self-employed persons. So some folks that this maybe was their main source of income, they may have seen a big decrease. Dog walkers that maybe used to have a really robust business before COVID when we were all in the offices, their business may be way down now that a lot of folks are working from home, either permanently or semi-permanently. Some folks may have taken on additional gig income types of jobs to meet that need, that they may continue to do that. It may taper off. So those can be really complicated and require a lot of clarification in the file. And it's also tricky because it's often in combination with more traditional employment. It's just a supplement to it. So you may be doing a couple of income calculations, maybe a more traditional wage job and also a gig income job. So these can be some daunting files to do, but definitely not impossible. And just like with self-employment, when DOH is monitoring a file of somebody that has gig income, we're looking for completeness of documents and certainly the clarity of calculation. So with these folks, as with all files, be making sure that your file is really painting a story, and that, even if the monitor comes 2 months after you do it or 6 years after you do the file, we're going to be able to understand what the income was, how it was calculated without needing clarification from the person that did the file. Certainly, the person that did the file is not going to be at that property for the rest of their life. So we want that file to be able to kind of stand on its own and not require a person to explain how the calculation was done. So take those monitoring suggestions as you work on your self-employed and gig income households. All right. Another note about this is you may see some self-employed folks that are routinely collecting unemployment. So like actors, entertainers, they may do a few jobs and then may collect unemployment and kind of cycle on and off of those two types of work. So in those type of scenarios, to really have a conversation with them, document it for the file, it may be more accurate to look at 2 or 3 years of historic earnings and see how much in unemployment they've collected kind of over time. Since they're not using it straight, they may just collect a few days here and there. So each scenario is different, and just making sure you're really understanding what the scenario is before you try to do any calculation. You could also include seasonal workers in these categories. The HUD Part 5 uses the example of a roofer. And so this is somebody who works a part of the year and then either has a different source of income or doesn't work during the remainder of the year. So that kind of fluctuating or atypical income can be sometimes categorized in this way as well. All right. We'll jump now to rental properties. And after rental properties, we're going to walk through tax returns and kind of see where to be looking on the tax returns for some of this information. And so for rental properties, this is applying to any person or household who may rent or lease real property. So that may be a home or an apartment that they own, may rent out a piece of land that they own. And so with this, like self-employment and gig income, it's important to really know what's happening before you try to calculate anything. So if this person owns a piece of property and they have a year-long lease, with one household, and the household pays $2,000 a month, well, that's going to be pretty easy to calculate the gross income from, just obtaining a lease from it or rent receipts, depending on how formal it is. You may be able to document this via third parties. So if somebody is renting out their property on Airbnb or they're renting out their land on HipCamp, there may be, some third party way to collect documentation of what type of income they've earned from it so far, so that they can put together a more profit and loss statement type document. And the tax returns, including Schedule E, will be very helpful for this type of income. And we'll walk through what to look for on those schedules in a moment. And you're going to calculate it very similarly to self-employment. You're going to look at the gross earnings less expenses. The expenses will be a little bit different than somebody who is, doing a more consulting or freelance type job or gig income job. And DOH is going to be, the other thing that could be very tricky about this is calculations for those who are currently residing in the unit. So say somebody is, you maybe have a senior who is in their home and they are trying to downsize and they can't afford their home anymore and they want to move into your affordable property. That can be a little bit complicated because you need to understand what their intention is for that property once they move out. Is their intention to rent it out to family? Is their intention to sell? Is there, have they not decided yet? And so if their intention is to rent it out, then you're going to need to ask some probing questions of, do you know who you're going to rent it to? Are you going to rent it on, more of an app or to a family long-term, so that you can best project what that income is going to look like in the next 12 months. And that may fluctuate. So when you do your recertification with them, they may have said, I think we're going to sell it, but then they may have, changed their mind when they wanted to wait until a different time of year. So there's a lot of conversations, and you'll want to flag those households so that at recertification, you continue to ask those probing questions of, when you moved in, you had this house and your intention was to do X, Y, Z. Is that still the case, or has the plan for it changed? And when DOH monitors these files, we for sure are going to be looking to see that your application and your income and asset questionnaire is asking about real estate and asking if the person does own real estate or real property, that the file is clearly documented with what the intention is, what type of income is earned for it, and that any anticipated income from that asset is included with the household's annual income calculation. If that home is acting as income, and you'll not include it as an asset so that you're not double counting income from that. So if the home is, being rented out and generating $2,000 a month of passive income for the household, you won't also put that asset in the kind of lower part of your certification where you would list, more traditional assets, because otherwise the cash value of it is going to impact that imputed income calculation and potentially drive up their income, higher than it really should be. If the household is using kind of a third-party platform to rent their home, they'll generally receive a 1099-K or miscellaneous, and they'll need to use that to file their Schedule E. And one important note, if your agency is running a DPA program, please do speak with your asset manager regarding rental properties. All right, we'll dive now into kind of some tax returns, and we'll look at tax returns and the related schedules twice on today's webinar. So for folks that are coming in with the three types of income that we've talked about so far, it's important to start with the 1040. And today we're just going to talk about the federal returns and not dive into the Colorado state returns, just because if you understand how to look at the federal returns, looking at the state ones are a little bit more easy. You may also have folks that their last year, they maybe lived out of state. So as long as you understand how to look at federal, you'll be a little bit more comfortable looking at the state returns. So when it comes to qualifying your applicants for your project or your program, tax returns are your friend. They can definitely make your file during a monitoring, but they can also break your file during a monitoring. So let's go through the process that DOH is going to be looking at when we're reviewing tax returns in your files for folks that have these unique types of income. So the 1040, which we have up here, is a summary of all of the sources of income. So wages, Social Security, pensions, IRA distributions, dividends, self-employment income. This is kind of the summary of all of this. And just a reminder that if the net income from self-employment is a negative, we treat it as a zero for income certification purposes. So outlined in red up here towards the top is where all of the tax-exempt interest, qualified dividends, IRA distributions, pensions, Social Security benefits will be listed. And then the taxable amount will be in the column to the right of those. But If you see any income in those boxes, your file needs to have documentation of it. So if you have somebody that has qualified dividends of $300 on line A, and we don't see anything in the file about an investment account, that will be a finding, because the tax returns are telling a story that somebody has income from that, but there's nothing in the file to clarify where that income came from. And similarly, on lines 8 and 10, those would be incomes from the sources that we spoke about earlier. So if there is income or loss on any of those lines, we're looking to see that the subsequent schedules in the file substantiate where that income or loss came from. All right, so if somebody has self-employment or income from a rental of a property or real property, we'll be expecting to see a Schedule 1. And so line 3 on here, hopefully it's not too small, will show any business income or loss. And so in that line, it would be the net income for your gig workers, your self-employed folks. That's where that number is going to live. And line 5 on here, which is the rental real estate, also royalties, if you have any folks here that are receiving royalties. S corps, trusts, that net income or loss would be on line 5. And down below that is where the information kind of lands there and then get transferred up to the 1040. So in this land where I think most people either have their taxes done or use something like TurboTax, we're not really seeing much discrepancy transferring over from one schedule to another schedule up to the 1040, just because the computer is doing it. But understanding where this information comes from when you may be new to this type of calculation can make the documents feel a little bit less overwhelming. And if you feel more comfortable using these documents as a tool, you're going to be less likely to make an error or less likely to miss, clarifying something for a monitor that we may have questions on, when we come in a few months or a few years. All right, so for our self-employed folks, the information on the Schedule 1 comes from yet another schedule. So for self-employed folks, we may be all familiar with looking at a Schedule C. And so this is where our self-employed folks that are gig workers or true consultants will summarize their business and all of the income from their various 1099s, or if they've done their own calculations and own tracking and, say a spreadsheet or QuickBooks. This is where they're going to compile all of those sources of income and also start to back out any eligible expenses for that line of work. And so for Schedule C, to support this, a lot of times folks will have maybe a handful of 1099s. So if somebody's a freelance writer, they may have 1099s from a bunch of different publications, and they'll add those all together and put them on one Schedule C, start working on the expenses. Beginning with tax year 2020, folks that used to receive a 1099 miscellaneous are now receiving a 1099 NEC, or non-employee compensation. You may still see a few 1099 miscellaneous float through. The onus by the IRS is on the worker to contact the employer to get the correct tax form, but I don't see any penalty for people using the wrong version of the 1099. I think over time we'll start to see folks receiving the correct version of that. You may also still see 1099 miscellaneous floating around for some other types of income. And on the Schedule C, I think you can see here, they'll have the name of the proprietor, that'll be your applicant, or the household member that has that freelance income, their social security number. If they have employees, they'll need to have an EIN, but if they, it's just them, they're not running a business, they're just, driving for DoorDash or walking dogs through Rover, they won't need to have that EIN if it's just them. And down under Part 1 is where you're going to start to see, all of the incomes coming together and being summarized, and then of course backing out any expenses. I did this form is 2 pages long, so you can see I kind of truncated some of the lines just in an effort to get it large enough that we could see in this presentation. But you can see under the expenses category highlighted in green here is going to be, you know, the profit from that venture, or if there's a loss, there's of course some additional questions below that. But any profit here is going to transfer up to the Schedule 1 that we looked at on the slide prior, and then transfer up again to the 1040. Hopefully all those layers make sense. I think as you start to work through some of these on your own, you'll be, you know, more comfortable seeing kind of how those numbers are translating from one schedule up to the actual tax return. Helpful on the Schedule C is looking at the business name. So if somebody on their application, sorry to be picking on dog walkers, but somebody on the application said that they were a dog walker, and you get their Schedule C, and the Schedule C for the business name or the type of income is that they're a freelance writer. You're going to want to ask some questions of, you know, you said you're a dog walker, but last year you were a freelance writer. There may be actually more than one Schedule C. So if people have, you know, divergent types of freelance income where the expenses are really going to vary from one line of work to another, you may see multiple Schedule Cs that you would want to make sure you're collecting and evaluating independently, with each with their own business plan, profit and loss, and of course the tax returns with supporting documentation, and really analyzing across the board there. So people with multiple lines of freelance work can get a little bit complicated. Sometimes people put them all into one just for ease, where it's like dog walker and freelance writer. But a lot of times you'll see them separated out. Just depends on how organized that household might be. Right. So the next schedule that I wanted to touch on is the Schedule E. And this is what you're going to see if somebody has rental property, they'll have a Schedule E. And because those expenses for the home are very different than a more traditional self-employed or gig worker that we talked about earlier. So you're going to see still the 1040, the Schedule 1, and a Schedule E. And on here, just be paying close attention to under Part 1, they'll need to list the physical address of the property that is generating the income. So making sure that that lines up with the conversations you've had with them. And of course, if somebody's plan is, I'm going to downsize out of the house that I live and move into this affordable property and then rent it out, they're not going to have something like this to look at yet. But certainly they may have this, in the following year's certification, or if this passive income has been a source of income for a while, you will expect to see this. And on here, it's going to list any rents received, kind of about halfway down under income, it'll show the rents received. So in our example earlier, where we said that we have a household that was collecting $2,000 a month in rent, we have the lease, that all checks out. Also look at the tax returns. Is it declared on here that the rents received on here is, $24,000 a year? Or does it say on here that they collected $50,000, and, kind of are those things in line with what you're expecting to see? And if not, ask probing questions and document the file. And expenses are backed out a little bit lower than that based on if they have one or more properties that they have passive income from. And there are a slew of expenses on here. Again, I truncated it just so that this could all fit on one page. But that bottom line, line 26, that's the income or loss that transfers to Schedule 1 on line 5 and then up to your 1040. So just a visual of kind of where some of those types of income are going to be documented in your file. I hope we still have everybody. No questions yet.
No questions yet.
Great. Love that. So we'll do one quick income calculation here. This is hyper simplified, again, partially to fit on the screen and also just for time. But we have a quick income calculation here, we have Rachel. She's self-employed, and she's applying to move into your DOH-assisted property, to a DOH-assisted unit. So you're going to be collecting, as we know, for self-employed persons, their business plan, prior year's tax returns, and the profit and loss statement. So Rachel's self-employed. Her business plan states that since 2015, she's been doing landscaping and snow shoveling, very Colorado. And she charges, her business plan says that she charges $100 per snowstorm to do the driveways and the sidewalks. In the summer, she charges $50 per lawn, and she has additional fees for landscaping services. Very affordable lawn mowing. Her clients pay her the day that the work is done. They either pay her by Venmo or they give her a check. And so in evaluating her potential income, we're going to look at her prior year's tax returns. And in the prior year, she earned $28,500 and she had expenses of $6,000. And so we know that from her prior year's tax returns, we collected her 1040, her Schedule 1, and her Schedule C, and she had a net business income of $22,500. So that's kind of one of the things that we're going to be looking at. And the next would be her profit and loss statement. And normally in your profit and loss statement, it's going to be more detailed than this. It would say the 10 clients and when the work happened. But again, just to get this to fit on a slide, I kind of condensed that all. So we have broken down here by month from year to date. I just did through July, so it would fit. How much, what she did, how much she earned for the month. And you can kind of see that, in the winter months, she had, a good income. And then in shoulder season in April, she had no income. She didn't have landscaping work yet. We didn't have any snowstorms, so she didn't have any income from that. But then in May, her income picked back up again. And then she also broke down what her annual expenses were anticipated to be. And we can see that her expenses for 2022 are going to be a little bit higher, and that's maybe her insurance went up. Certainly the cost of gas went up. So her expenses are going up. So it's important to be looking at not only what she earned last year, but what she's anticipated to earn this year. And in order for us to calculate what she's anticipated to earn, from this point forward, we look at what she's earned from January to July and annualized that forward. And we came to $30,800 and change. And then we back out the business expenses. So in this example, she grossed more, or is anticipated to gross more this year, but her expenses are also increasing, and kind of in tandem with that. So her net business income is actually pretty close to what it was last year in this made-up example. So last year she earned $22,500 was her net, and this year we're anticipating it to be slightly more, $22,657 and change. So on the certification, DOH would expect to see in the file, the tax returns, profit and loss, business plan, and also your calculations of how you got your, your income for the next 12 months. So we would expect to see this calculation either on the calculation tape or broken down, however your organization does that. And just remember, back to one of the earliest slides, owners are expected to make a reasonable judgment as to the most reliable approach to estimating what the household will receive this year. So even though we know that she earned a little bit less this year, we're projecting she's going to earn a little bit more this year. Maybe she got good clients. Maybe she's charging more because she realized $50 isn't enough to mow somebody's lawn for 2 hours. So, making that judgment call of and documenting the files so that reviewers for years to come can know where you came from and what the circumstances were for that. In this scenario, I should mention that if her only job was, mowing lawns, and she had a large period of time where she wasn't earning income from that, it may not be appropriate to just annualize the year to date, but in this pretend scenario, it did make sense because she does have work year round in more or less the same industry. All right. So now we'll chat briefly about annuities. So we do see at some of our properties folks with annuities. And so this type of income applies generally to retirees. It is a contract that is sold by an insurance company. And there's a few different types of these, but they can generate payments at specified intervals. Fixed annuities guarantee that certain payment amount, while variable annuities do not, but there's greater potential for returns. With annuities, it's very helpful, as with many types of income, to try to get that third-party verification form. I'd say annuities, kind of the remaining types of income we're talking about, is one of the easier ones to get the third-party verification form. So definitely work with the applicant to, try to connect with, whoever can complete that verification form and really try to obtain that. It's going to save you a lot of headaches. How to calculate: generally, a person who holds that annuity from which they are not receiving payments will also be earning income. And in most instances, a fixed annuity will be earning interest at a specified fixed rate. So again, do a little homework, a little cleaning on your agency side. Take a look at the third-party verification form you're using and make sure it's asking like the right probing questions for scenarios like annuities and some of the incomes that we're going to talk about next. You're going to calculate. We spoke about how to calculate. What's tricky about these? There are some nuances depending on what type of annuity it is. A hybrid annuity is an investment that's allocated between fixed and variable. A deferred annuity, principal and earnings are paid in a lump sum when the contract is cashed in. There's an immediate annuity, which is a lump sum amount that's paid, and principal and earnings are paid periodically over a predetermined period of time. And a life annuity, which is most common, it's a series of future payments for life. And generally, when the holder has begun receiving regular and recurring payments, they can no longer convert it to a cash, like a lump sum cash payment. So in that situation, the holder will receive regular payments from the annuity, treated as regular income and not very complicated to calculate. And it'll no longer be considered an asset. HUD Part 5 does have a lot of information on annuities. So if this is totally new to you, definitely dust off Part 5 and take a look at the section on annuities, and it can help build your confidence in reviewing some of those. When DOH comes to monitor a file with somebody that has income from annuities, we're going to be looking to make sure that the annuity, either the income or the interest from it, is calculated correctly. And does your verification form ask the right questions so that you can make a correct calculation? All right. Next is trusts. So trusts are also a legal arrangement generally regulated by state law in which one party, which is called the creator or the grantor, transfers property to a second party, which is the trustee, who holds that property for the benefit of one or more third parties, the beneficiary. Generally, the beneficiary is the one that is applying for your housing. The trust can contain cash or other liquid assets or real or personal property that could be converted to cash. Also with trusts, we strongly suggest that, in agreement with HUD's Appendix 3, the most preferred way to verify this and the easiest way is certainly going to be a well-constructed third-party verification form. Trust documents can be very complicated to review and can be murky, and really getting a third-party verification form which clearly spells out what type of trust it is, whether it's revocable or non-revocable, also known as irrevocable, what type it is, and when does the person begin receiving access to these funds? Is there going to be a fixed payment? Is it a lump sum payment? So that you can make sure that you're doing the right type of calculation for it and treating that that item correctly. So the basis for determining how to treat the trust relies on who has access to it and whether the principal in the account can be accessed yet, if the person needs to reach a certain age, or if the grantor, if it's available upon the passing of the grantor. And so if no family member has, I skipped the second one. If any member of the assisted household has the right to withdraw funds from the account, the trust is considered an asset and is treated like any other asset. But if no family member has access to it, either the principal or the income at the time that they apply and anticipated in the coming 12 months, that's not included as an asset because they can't access it. It may be out there, but maybe they can't access it for 5 more years or something like that. So making sure you really understand the terms of it. And you'll only count this as income if it's currently available to the applicant or family member and it's being drawn down on in a regular basis. So what's tricky about these is getting that third party can sometimes be a little bit complicated. And DOH is looking to make sure that the owners of the property that's doing the certifications really ask the right questions and are making sure that they're calculating it correctly. At our Assets 201, we're going to talk a little bit more about how to treat trusts as an asset, both as the grantor and the trustee and as the beneficiary. There's also a lot more nuances with regards to special needs trusts. So if you're working at a property where you have applicants or tenants with special needs trusts, you'll want to look into that a little bit more. And the last caveat about trusts is that if you have a minor in a household that's receiving recurring income from a trust, that income is always included in your household's annual calculation because that's unearned income, even if the person's a minor. And all of those income inclusions and exclusions are in Part 5 if you need a refresher on that. All right, income from investments accounts. I see we've just got 10 minutes left, so we'll go a little bit quickly through this. But so income from investment accounts is anybody who has access to an asset generating income in the form of interest or dividends. So investment accounts may generate income only once a year, but it's still considered income. And as with all things, third-party verification is certainly the best way to verify this type of income, making sure that your verification form may be the same one that you use as for your checking and savings accounts, or you may have a retirement account verification form that's asking specific kind of unique questions for investment accounts. When you're calculating any income from these assets, you're going to look at the yield or dividend versus the rate of return or return on investment. You're going to include any annualized interest or dividends, even if those are reinvested into the investment. You will not include on either income from the asset or anywhere else in your certification, return on investment, capital gains, capital growth. Those are not to be confused with interest or dividends. And so tricky, getting the third party, I think out of all of these is the most complicated for retirement accounts or investment accounts. And then if you can't get that using the statement, each statement is very different. And so in preparing for one of the examples today, just looking online of a couple different brokerages, they have a lot of times a sample statement and how to read it. So that can be really helpful. So if you're looking at a statement with Vanguard, you can go to Vanguard's website and they may have a tutorial on how to read a statement. And also calculating the cash value of investment accounts can be really confusing. And we'll talk about that in the Assets 201 webinar early next year. And when DOH is looking at income from investment accounts in your files, we're looking for very clear calculations and memos to files, making sure they've collected all pages of the statement if that's what you're using as the basis of the calculation. We're looking at the timing of your verifications. Was this within 120 days, 6 months for home? And it's also very helpful for your reviewers. If you list each account separately on your certification form, if you're using a tick, listing them separately on there can really help speed up a review. And we'll zip through this, but this is kind of a sample of what a good verification form for an investment account looks like, where they're actually asking for, the market value, the surrender fee or penalty, and the annual interest and dividend income. So you would just take this whole $300 amount and, add that onto your certification. If you're having to look at a statement, again, step 1, don't panic. Step 2, find some resources to help you really understand what you're looking at. This particular sample, John Doe with their Fidelity account, it spells out on there, what their interest in dividends is as of July 31st of 2015 is when this pretend statement is from. And so you would know that from January to July, this is how much the account generated in dividends and interest, whether it was reinvested or paid out, that doesn't matter. You'd be able to annualize this and include it in your income calculation. All right, and the last source of income that we'll talk about today is required minimum distributions. And we're including this because it can be really confusing, and there was also a lot of changes that came up recently. So in 2019, there was an act called the SECURE Act, or the Setting Every Community Up for Retirement Enhancement Act. It's made some major changes to the RMD rules. So if your compliance manual hasn't been updated since COVID, dust it off and go in and make sure that it gets updated with some of these new regulations from the SECURE Act. So RMDs, or required minimum distributions, are generally the minimum amounts that a retirement plan owner must withdraw annually. Now it's when they reach 72. So if your documents are reflecting 70 and a half, that used to be the magic age when these withdrawals needed to start. So that would be a trigger to know that your documents need to get updated. And it applies to, a myriad of these plans. Getting a third-party verification for these is also really, really helpful. You can also use statement or tax documents to calculate what you anticipate the RMD for the year to come. If you'll want to use that RMD in your annual calculation, unless the person chooses to withdraw more than the minimum, which is allowed. If somebody's required to take one of these and they don't, you should still include it in your calculation because they are required to take it. And if somebody doesn't take it, they face a pretty severe tax penalty. And what's tricky about these is if you have a household member who's either applying or certifying and they're turning 72 in the coming year, or if they just turned 72 and they may not know about this yet, there may be a little bit of education that needs to happen on that. So if you have somebody that's savvy with explaining it in a way that can be well understood, that might be a helpful, some helpful learning for your tenant or your applicant. The requirement to take RMDs was paused during COVID in 2020 when the stock market was kind of all over the place. So people weren't required to take them, but it was reinstated in 2021. So if you're looking at your files from 2020 and you see somebody that maybe this person should have been subject to an RMD and it's missing on this certification, having that conversation with them if they decided not to take it that year because they weren't required to, or was it truly overlooked? There are a lot of nuances with this rule. So whenever you come to somebody that may or does have an RMD, go onto that IRS website and kind of look and see if there's any documentation that may impact the way that you calculate it. And for sure, when we're looking at these files for some of our seniors that may have retirement accounts, we're going to want to see very clear calculation and timely documentation. All right, and so just here is where you'd see that information showing up on your the household members' tax returns. The interest, dividends, the IRAs will be on these first three lines. If there's pensions or annuities, again, those are going to be on line 5. Social Security is going to be on line 6. SSI benefits don't get any tax document annually as they're not considered taxable income, but we sometimes do see people just do the math themselves and put it on there. And we did have a few very straightforward examples, which we'll skip in the interest of time, but essentially we have our recap here. Is just making sure that regardless of what type of income you have, all amounts, monetary or not, which are going to the family or anticipated in the next 12 months, is considered income. Making sure you're showing your math. Can't say that enough. Make sure you understand the order of preference for verifications. Appendix 3 from HUD is one of the documents Ariel shared out. And then some homework for everybody is just making sure your application is asking the right probing questions and that your verifications are going to ask the right questions so that you can do the math. And, thinking about COVID and, really thinking about how that may have impacted somebody's income up or down in the prior and current year. And of course, DOH is looking for proper verification and that you're actually asking the right questions. That's the end. I have just some resources here, which everybody got in the handouts. And if you have wish to contact us, here's Ariel and my contact information. We've got a large and growing staff. So if you wish to find your exact asset manager by funding source, just go to our website and we have it all broken down there. Happy to stay on if there's any questions, but I didn't hear any dings.
We don't have any questions in the chat feature. Want to give a second for those who might be processing some questions right now. But in the meantime, I want to make another plug for our October 5th webinar. So it's not going to be the second Wednesday this time. It'll be the first Wednesday, so October 5th. And we're going to cover how to use your contract as a resource. Alrighty. Again, thank you for your time. If you have questions, reach out. We're here for any questions that you have. Reference our website. You can go by funding source or just reach out to Alston or Ariel and they can get you to the right folks. Thank you guys again. Have a wonderful day.